Speaking of fundamentals, this might be a good place to discuss our portfolios. And it might surprise some listeners to hear that we really haven't made a substantial allocation change since just before COVID, but there's a good reason for that. And Phil, can you take some time and discuss why we haven't made adjustments amid all the volatility and why our convictions remain basically where they were in 2019 and early 2020?
Sure. We've made some adjustments in some holdings, not dramatically. And as Bob, as you pointed out, we've not made a major change in our sector allocations since right before the pandemic. And taking us back to December of 19, the market was overvalued fairly significantly. And just about every sector was above median. If it was not overvalued, it had questionable earnings outlooks. So as we approached the first of 2020, we saw a lot of risk in the market. Obviously, we didn't know what was coming down the road with COVID, but a lot of risk in the market. So the structure of our portfolios, and this had developed gradually over the 12 months of 2019, was to not include any significant sector allocations, but to upgrade the quality of the portfolio. And I'll give you some statistics here in a minute, but continuing through 20, 21, 22, we had periods again of overvaluation at the beginning of 22, compounded with the increasing interest rates. So the risk in the market was again pretty high. And again, we had most sectors overvalued. So the opportunity to take advantage of really cheap sectors wasn't there. In fact, if you look at consumer staples and utilities, for example, that are typically defensive sectors, they were in the 85th percentile of their valuations. So they were just as overvalued, or if not more so, than the market. So, those had developed overvaluation levels because of the repressed interest rates. People were buying those stocks for the dividend yield. But I digress. So our approach to the portfolios beginning or developing through 19 and then holding since then has been a quality allocation. So within each sector, we screen a database of roughly 700 companies that are 7 billion in market cap and higher. And the portfolios have been, with the quality screens we use, a couple examples. Debt to EBITDA in our portfolio, our core growth fund portfolio, 2.1 times versus the universe at 3.8. So roughly half of the universe level of debt to EBITDA. Forward PE, we're at 85% of the universe. Return on equity, slightly higher than the universe. Price to sales, roughly half of what the universe average is. Trailing PE, again, about 60% of the universe. So, and still having good earnings growth over the 3 and 5 year period. So it's been a quality in large cap positioning, and it's all in response to the overvalued level of the market. Somebody might ask the question, well, what happened last fall when the market was down 25% at the lows? What happened to valuations then? Well, a lot of the sectors in the market in general pulled back to just above median valuations, but they did it pretty much uniformly across the board. So it did not again prompt any changes in our allocations, but emphasized the fact that a diversified sector portfolio, but with a quality screens that we use, was still the place to be. and now we're overvalued again in the market, and most of the sectors are overvalued. The one that I'll point out that's been consistently more attractive has been healthcare. That has not been as overvalued as the market in any of this period that we've discussed, and has always maintained a double-digit earnings growth forecast through that whole period. So that's been a consistent overweighting for us, contrary to the underweighting in financials. So I hope that helps put things into perspective and how we've been looking at things and why we have not made any major changes in allocations within the portfolios.